Hi, this is Insight Pulse. I bring you the latest insights, trends, and stories that matter. Oil prices are rising again, and everyone is asking one question. Is it because of war, or is something bigger happening behind the scenes? Today, we're peeling back the curtain. Is the conflict we see on the news the real driver, or just a convenient scapegoat? Let's break it down. Every time conflict breaks out, oil prices spike. It's a pattern we've seen for decades. But here's the truth most people don't realize. War is only part of the story. To truly understand why you're paying more at the pump, you need to understand how the entire global energy system is interconnected. It's a complex machine with many moving parts. At its core, oil prices are driven by the most fundamental rule of economics, supply and demand. When they are in balance, prices stabilize. When they aren't, volatility reigns. On the supply side, we have the big three, OPEC, led by Saudi Arabia, the United States, and Russia. Together, they control the vast majority of the world's black gold. On the demand side, the engine of the world is shifting. Rapidly growing economies like China and India are hungrier for energy than ever before, creating a constant floor for prices. When demand rises, as it has in 2026, prices go up. But when supply is intentionally restricted or accidentally disrupted, those prices don't just rise, they surge. Now back to the big question, does war cause these surges? The short answer is yes, but rarely directly. It's not about the barrels lost, it's about the barrels feared to be lost. Global markets hate uncertainty. Traders aren't just buying oil for today, they are betting on tomorrow. When a war starts, they aren't looking at current production. They're looking at potential threats. Will shipping routes be blocked? Will refineries be targeted? These questions trigger panic buying. Investors start stockpiling paper oil in the futures market, driving up the price for everyone. This means prices often peak before a single drop of production is actually lost. It's a psychological feedback loop where the fear of what could happen becomes the reality of what is happening. Think about this. If tomorrow, global supply was projected to drop by just 10% next month, what do you think would happen to prices today? Let's think about that for a moment. Exactly, they would skyrocket immediately. But war isn't the only hidden force at play. Let's look at the factors the headlines often ignore. Hidden force number 1, strategic production control. OPEC Plus often cuts production not because of war, but to maintain a price floor that keeps their national budgets balanced. It's a calculated chess move. Meanwhile, the U.S. shale industry acts as a swing producer. When prices get high enough, they ramp up. But in 2026, capital discipline and environmental regulations have slowed their response. Hidden force number 2, economic growth. Despite the headlines, the global economy is expanding. As billions move into the middle class, their energy needs create a massive, immovable demand. And then there's the dollar trap. Oil is traded globally in US dollars. When interest rates rise and the dollar strengthens, oil automatically becomes more expensive for every other country. This currency power means that even if production is stable, a shift in the Federal Reserve's policy can send oil prices surging across Europe, Asia, and the rest of the world. Furthermore, many nations have depleted their strategic petroleum reserves. Without that safety net, any small market shock, war or otherwise, has a magnified impact on the final price. So you see, oil prices are never random. They are the result of a strategic tug-of-war between geopolitics, central bank policies, and industrial output. So what does the rest of 2026 look like? We see 3 possible scenarios unfolding right now. Scenario 1, the continuous surge. If geopolitical tensions escalate further and OPEC maintains strict cuts, we could see record-breaking prices that test the limits of the global economy. Scenario 2, the new normal. Stabilization occurs as conflicts ease and new supply from non-OPEC nations finally reaches the market. Prices remain high, but the volatility stops. Scenario 3, the long-term shift. This surge acts as a catalyst, accelerating the transition to renewable energy. We see a structural move away from oil dependence faster than anyone predicted. The future isn't fixed, but the transition is inevitable. The current surge is just another chapter in the story of how energy defines our world. Remember, oil prices are about more than just war. They reflect the global balance of power and the strategic choices made by nations and markets every single day. If you understand these forces, you aren't just watching the news, you're predicting it. You're already ahead of most people in navigating this complex landscape. Follow and subscribe to Insight Pulse to not miss our daily deep dives into the trends that shape your world. Because the more you understand the world, the better you can navigate it. I'll see you in the next one.